All right. What is up, Justin? I'm super excited to go through this policy with you. Tell me just a little bit. I know you sent me over a policy that you got an illustration. Why? Why'd you purchase? Or why were you thinking? Because you didn't, thank God, purchase the
Yeah.
policy. Yeah, what was the reason? What were you looking into it for?
I think mostly I like the idea of the cash value growth. Um, I think I've done a little bit of research like on YouTube, like max funded cash value life insurance can be just like another asset. Especially like I'm of the opinion that tax rates might be a lot higher when I retire in 30, 40, 50 years, who knows?
Right.
But and then along with like the living benefits, the main thing, my dad, thankfully, is healthy, but his sister just passed away last August. So I'm like, dang, life is not guaranteed at 52, so super young.
Goodness.
And she had life insurance, so I saw that, and I'm like, that just takes another pressure off. Not that I have kids or I'm not married or anything, but
Yeah.
it can only help get started if
$100%.
and I have about, let's call it like $300 a month. I was thinking to like put the just kind of extra putting in my just savings account now, and
Yeah.
like life insurance might have a place, so I want to see what was out there. I didn't like what I saw, but and the only reason I knew that because I've done kind of YouTube quote unquote research,
Yeah.
but yeah, that's kind of where I'm at.
Awesome. And then $300 a month. This is because you said it's kind of like what you're putting into your savings anyway. So
Yeah,
just trying to see what else are you doing with your money? 401k from work.
401k through work,
Okay.
IRA, the Roth IRA, so Roth 401k, Roth IRA,
Perfect.
um, and then that's about it, I guess. Yeah.
No, that's you're 25. I'd say that that's pretty awesome. Um, and then you don't have any other life insurance.
No, except
Current
through work.
policy,
I think we
you
have
have
like a
some.
1 year salary, I
Okay.
believe.
Okay. So awesome. And then yeah, we're looking for the cash value. If you were to think about like the next 10 years, do you have plans to want to touch the cash value? Or is it more so like it's there if you need it, but like no actual plans to touch it?
Definitely no actual plans. But yeah, and that's one of the things they talk about like on my YouTube research is like, but you might want to look for XYZ like loan provisions in case you do want to like you could always let's say I'm buying a new car in 5, 10 years. I could always compare this interest rate versus that interest rate or down payment on a house or whatever. But no, just I don't own a house or anything. I just rent and I have a fairly new car, so I won't need one anytime soon. But I like the optionality.
Yeah. I mean, I had a client pay for her vet bill with her policy.
Okay.
She was like, well, if I put it on the credit card, put it on the credit card, you know, and then she already paid the loan back. So like
Yeah,
the interest rate was 2.75%, you know,
that's
like
crazy.
it's a huge value to be able to go into your policy and be like, hey, life happened. I need this and not pay
Mm-hmm.
18% or drain your like emergency fund
Mm-hmm.
too,
Correct.
right? Because I've
Yeah.
actually done this. I mean, I've taken money from my IUL because don't want to put it on the credit card, don't want to drain the cash, the liquid cash,
Yeah.
just pull it,
Yeah.
right? And then pay it back. So now you went through Ethos. You went on there to say, hey, I want to get this policy. Like, here's my information. Give it to me. And obviously, they didn't just approve you and say, hey, it's ready to go. An agent called you.
Yes. Correct. Yeah. So I think I probably could have done that with like term, but I wasn't interested in term. So I went to like the IUL page and they wanted my information. I'm like, okay, whatever. I'll probably get a phone call. And yes, that's exactly what happened. The agent called. Maybe took a little while, like 2, 3 weeks later.
Which is that seems odd too, right? But
Yeah.
okay, no problem. I yeah, I'm glad that they don't just have an automatic approval because once we look at this policy, I mean, you already know it's not wouldn't have been great to just have this approved automatically and then be going, okay, wait, what the hell did I get? So I have it pulled up and we'll just kind of go through a couple things here. So obviously, too, like Ethos is not a company, it's not a carrier, right? They say like it's the Ethos Index Universal Life Insurance Policy, but and they give you, you know, information here and things about the policy, but if we keep scrolling down, it's actually Ameritas,
Okay.
right? It's an Ameritas IUL. So Ethos is like a company that is working with other carriers and then giving you a quote or an illustration from an actual insurance carrier. So, okay, Ethos, they are a really highly rated company, so that's a good thing. But let's go down and look at this in more detail. So, This policy actually comes with a lifetime income rider right here. Did you learn about that at all? That
No,
lifetime income
it was
rider?
a literally like I looked at my phone log like a 22-minute phone call, and we were like almost all the way through.
Is insane. Um, so the death benefit's actually not increasing. It's an option A. So it's a level death benefit, meaning that it's going to stay the same throughout the life of the policy unless certain tax limits are hit. And that death benefit, 951,400, which is insane. $300 a month. The lifetime income rider level are increasing. So you would have the option, which this is a really cool thing, you would have the option to actually get a guaranteed income for the rest of your life, assuming that there's cash value enough that they'll cut you a deal, kind of like an annuity. Um,
Okay.
know much about annuities. Annuities are typically give them money and then they give you an income that you can't outlive. Several different life insurance companies are starting to include that as an option. So you would have the option of doing a level, static income for the rest of your life or increase it by 3% every year,
Okay.
which is pretty cool. But of course, that would all be dependent on the actual value of the policy. And if we come down here, they're saying that at age 36, not sure why that's the trigger
Yeah,
date,
11 years.
you have 31,000 in the cash value, and so there's nothing
Oh,
for income options. Great. Awesome. Love it. Thanks, guys, for that breakdown. But where we want to go is if we keep scrolling, the index options, right? So the different index options that we have, it's the S&P and then the BNP Paribas, which when you maybe don't recognize the name, that's going to tell you that it's like some proprietary index that was created for the life insurance product. Even this S&P 500 sector rotator daily, good Lord. It's like a non-volatile S&P, the way that they're
okay.
tracking the index, but it's not just the S&P. Now, they're saying that there's a cap on it. They're not telling us what the cap is. There it is, 8.5%. So year to year, 8.5% is the most that we can earn. We get 100% of the growth up to the 8.5, right? Okay. The minimum cap is 3% current, and minimum participation rate is 100%. So they're just saying they could fluctuate the cap throughout the life of the policy anywhere from three or down to three. Currently, it's at 8.5. And then the participation rate is how much of the growth that we're ultimately getting to benefit off of. So that's 100% of the growth up to that cap. Then you have the option to do a 2-year S&P 500, where every year, every 2 years, the most that you could earn is 19.1. Biannually, it can be as low as 6%. So you wouldn't earn anything on year one, but by year two,
Mm,
you could earn up to 19% because they're going to take the
okay.
return over the last 2 years. And then we have this other proprietary index as well. Doesn't have a cap, higher participation rate of 180%. But you see this daily 5% excess return.
Yeah.
Ultimately, the workings of this index are that it stays around 5%. So they're willing to give you a higher participation rate to kind of make up for the fact that it's not going to return much. And then the BNP
Gotcha.
Paribas is actually on a few other IULs as well. But again, it's not, doesn't have a long history. It's not historic. That's why we're going to see these 200 and 258% participation rates because they're going to say,
Okay.
hey, since there's not a lot of history, we're going to give you an incentive. You want to use this, then we'll give you some extra interest. But then right now, if it's 201, the minimum participation rate is 25%. So they could drop it down to 25, 50, whatever, 100 even. Um, which like there's not a lot of index options, if we're being honest. We'll look at another company and there's at least nine, and there's four different index options. Here we're really
Okay.
seeing two. Let's keep going. I think they're talking about the loan rates here. So our loan rate, there is a fixed loan or a variable loan. With the fixed loan, they are saying that the current interest rate credited to the loan account is 2.5%. It'll never be less than one. Okay. The interest rate for the first 10 policy years is 3.38. So what they're saying is that they're going to charge you the 3.38, and then your policy loan is going to earn 2.5. So you're going to net negative zero point 0.8 or so, 1.72, something like that. So you're going to go negative on the fixed loan, which is usually how it goes. Okay. But then later on, after the first, on year 11, the loan interest rate drops to 2.4. So instead of
Okay.
3 point, it drops to 2.4, and then they still credit you that 2.5. So now you have a wash. You're netting zero. But then the variable loan right now is currently 4.9. Doesn't say that what the max variable loan rate is. Typically, it's about 6% because it's based on Moody's corporate bond yield. So if interest rates are high, then the variable loan rate is high. If interest rates are low, then the variable loan rate is low. Typically, we see it between 3 and 6% is what the variable loan rate could be.
Okay.
But um, the loaned amount of money, right, is going to be earning based on the index options. So if your index options returned 6% and you were paying this 4.9, then you're actually getting a positive 1% arbitrage, right,
Okay.
on the loaned money. So that's definitely the better loan option, but we're not seeing any indexed loan, which we'll go over what an index loan is when we compare. Just something to take note of. And then I just saw this limited limited historical information based on the fact that it was launched in 2017.
Okay.
So we got 8 years though, not bad. 8 years of history with the BNP Paribas. More just information, but here are the guidelines. So your initial guideline annual premium. The max contribution for the life of the policy is 10,575. And
Every year, right?
every year. Yep. So you're paying 300, well,
Yeah.
that's $3,600 a year. Right? Not even
Yikes.
close. Not even close. Then the guideline single premium, not super important. That's the max contribution over the first few years of the policy. And if you were to contribute 140, basically your policy would be tapped out in a way, and they'd make you stop funding your policy for a bit until the policy ages, and then you'd be able to go back to contributing. So not super important. But the seven pay is an interesting one because the seven pay is the max contribution per year for the first few years of the policy. So it's 48 grand. So technically, you could get almost $49,000 year one into this policy. And if you took advantage of that, right, that's where this $140,000
Hmm.
max contribution comes in. They're saying, hey, if you do that and you hit 140, you're going to be tapped out, right?
Okay.
And with a level death benefit, the reason that these guidelines like would come into play at all is if you said, hey, let's imagine you're like, hey, I got, 40 grand I want to throw into a policy. Well, I would make, and you only want to throw it in for 5 years in a row, right? We'd want the seven pay to be 40 grand and we'd want to fill it all the way up until that guideline single premium. And because of the level death benefit, policy would be fully funded in that time and not actually want any more contributions. But yeah, not
Okay.
exactly what we're doing at all here. Not at all. Not at all. Um, then we have the 20-year no lapse guarantee premium, which is basically saying if you want to keep the policy in force and that's it, you don't want to build a cash value, and you don't want the policy to lapse, then monthly you need to be paying 265.
Which is barely below what I wanted to pay.
Just barely below what you wanted to pay. Exactly. So we're doing well. We're doing well. So you would have never built cash value and you would
That's
have
what it looked
just,
like.
yeah, barely keep the policy in force. Awesome. There's that income rider again, but it does have an overloan protection benefit, which is fine. The overloan protection benefit says like usually it's 65 or 75 years old, and if you pull out too much money, the policy will not lapse and they'll prevent it from lapsing if there's too large of an outstanding loan so that you don't get hit with tax implications, right? But like we already know, there's not going to be any cash value to pull from later. So irrelevant, but it is a nice thing that we want to be included in the IUL. Worst
Okay.
case scenario. So let's keep going here. Let's see. This is just kind of like more information about how it was set up. Great. Projections. Here we are. So they're showing a guaranteed policy value where no interest is earned. Then they're showing a 4.5% or 4.15% annual return, and then a 5.56 annual return. And in the guaranteed column, there's a bunch of nothing.
Yeah.
4.5% or 4.15. We have 4 years of zero. Even at a 5.56, we have 4 years of zero, which is honestly not as bad, maybe, as it could have been, that there's only 4 years of zero. Yeah, maybe. Because after 10 years, you put in 36 grand and we have 25,000.
Yeah.
And then you know the difference between the account value and the net cash surrender value?
The surrender charge that the company's putting on, right?
100%, yeah. And the account value is actually the amount that's earning interest. So even on year one, you'd be earning interest on 2,200, but you
Mm.
can't touch anything. And if you cancel, you get nothing back. Right. So by year
Yep.
10, you'd be able to access a percentage of the 25,000, not the entire thing, right? Usually like
Using loans. The 25 or 31?
the 25. So you're able to
Okay.
access from the cash value, but then you're earning interest on 31. Long term, 20 years, 45, 46 years old. We've finally got more money than what we've contributed.
Yeah. I
We've
think I checked. It was like year 16. I think I did the math.
got year.
3,600 times 16 finally. Like that seemed like a long time
It
from what
seems
I've
like a
seen.
long time. And do you notice when that was also on year 15 was the first year that the numbers were equal?
Oh, okay. I did not notice that.
That is
So
when
no
the
more surrender charge, I assume.
yeah. So it's a long surrender period too, in a way. To wait 14, 15 years to be able to access or cancel and get all of your money back. Long term, they did show that no more money was going to be contributed after age 65. So, okay.
Hmm.
140,000 was contributed. We've got, what did we end at? 305. So it more than doubled long term. And we still have $1 million in cash value. If you really wanted to have $1 million in death benefit your whole life, you would have had it and you would have
Yeah.
had some money. But the second that you pulled any money out of here, then your death benefit's going to drop
Okay.
immediately, right? Because your death benefit is going to pay off any outstanding loans. You don't just like pull the 332 out or
Hmm.
pull out 100 grand. They're going to say, oh, well, now your beneficiary only gets 851. You pull out 100 grand.
If you had to guess, Casey, how did he even come to that 951,488? Like, do you think he just button mashed his keyboard or?
I'm assuming that he basically gave you as much as he could while making sure that the policy would stay in force.
Okay.
There is some extra healthcare benefits on the policy. So this rider, this Care for Life rider, which we would have to see if it was an added rider, if it's coming with the policy, because it allows a portion of the specified amount to be paid early if you qualify for a medical condition or event. So basically, it's an accelerated death benefit endorsement. You become critically, chronically, terminally ill. The policy is going to pay out a portion of the death benefit to you to help cover medical expenses, pay your mortgage, your bills, whatever it is. But it
He did
doesn't.
mention that. I did like that.
Okay. And yeah, and that's pretty common. But the 4.15% column, that one lapsed at what, 86 years old? I mean, obviously, we didn't take out any money. So
Hmm.
didn't take out any money. And then this one is still staying just fine. So if you were death benefit focused at 96 years old, your 140 would have resulted in, I mean, the family getting 951,000. And then what happens to this 789? Just gets
I don't know.
eaten by the insurance company. Here is the index allocations. So he did put 100% into the 8.5% capped S&P, which is unfortunate because there's also a fixed account. And the fixed
Hmm.
account is earning 4.15%. So we could have easily taken advantage of that and said, hey, let's put 20% into the fixed account and earn a guaranteed 4.1. It's nothing special, but it's guaranteed interest for the year. But that's like the least of our worries, honestly, at this point. And if we look here, this is like the historical returns, right? Where they're saying the the BNP, what it actually did in the years, which we know that it wasn't available until 2017, so we can just like ignore all of that. So since it's been available, it returned 5.2 negative, 8.78 negative, 0.2 negative, 0.3.
Oh,
Wow, impressive. So over the last 5 years that it's almost been available, a negative return.
yikes.
Yeah, over 10 years, it's returned 1.76.
Still not great, I would
No,
argue,
it's not
maybe.
great at all. Especially when we have the S&P over here where you're like, okay, the last 5 years, 6.8, which he put it there. So that's the one thing he's done right. So otherwise, that is it. And this is just how he entered it. He said it's not a, oh, he did the MEC test. It's not a MEC guideline premium test, which gives us the guideline premium test versus the cash value accumulation test are our only two options. And ultimately, the guideline premium test puts the premium guidelines in place in the contract, whereas the cash value accumulation test is like a free for all. And they
Okay.
just say like, hey, you want to throw in 20 grand and then you only want to throw in 5 grand and then you want to throw in 100 grand, you can do that.
Mm-hmm.
But it's not very smart because if the second you put in like, even just 20,000 versus continuously putting six, the second you make that larger lump sum, all of a sudden the death benefit increases in your cost of insurance.
Mm.
So it's
Yeah,
better
not the
to have
goal.
these guidelines and know what's going to happen. Um, and then, oh, we got the expenses. So that's
Okay.
something. We have our premium expense charge. So premium expense was 252 a year, which is a flat kind of cost of doing business. So they're charging you 7% a year, like doing business, right? Okay, fine. Expense charge is like your admin fees, and it's going down over time. And then the cost of insurance, which is, the cost of the death benefit based on your age, your health, which it's pretty low to start off with. And then it increases over time, and then we don't have any riders. So that care rider wasn't added, it was included in the policy.
Okay. That's good, I guess, at least.
That's good, I guess. Yeah, he didn't just add more things. Ultimately, your expense charge drops to 120 after 20 years. And then that cost of insurance gets pretty high. Let's see.
Wow.
Yeah. Premium stops, so there's no more premium expense charge. And then the other expense charge is just 120. And then you're paying 2, 3, 5, 7, 17 grand, 20 grand a year in cost of insurance.
Wow.
And they're saying, well, you have the interest credited over here and you're earning more than that, right? Because you're earning on this account value. But still, it's it's ridiculous.
Yeah.
You were paying less than that per year. It shouldn't be that high. And that's just going to get worse over time.
Yeah, that is crazy. Obviously, I hope I live till 106, but
I hope so, right? And I hope so, and I hope that the cost of insurance is not 42 grand, tell you that. And then yeah, that's what we got. So that's
hey,
I mean, we're gonna night and day what I'm about to show you. I'm tired of doing these policy reviews. Honestly, I hate telling people that their policy sucks. So if you're a life insurance agent and you need this training because you're not getting it anywhere else, then you need to join LifeWiZE. LifeWiZE is an all-in-one training platform where you can get training on IULs from basic to advanced. Join us today at lifewize.io. I'll put all the information in the caption. So we're going to look at Midland National to do a little comparison because
okay.
I have now set this policy up for you. This is their strategic accumulator initial death benefit.
Wow. Literally
It's
less than 1/10. Less than 1/10.
literally like
1/10 would be 95 grand or whatever.
so wild, ridiculous. And then you are going to get extra healthcare benefits. You're going to get,
And I guess, can I ask you one thing, Casey? Because I
yeah,
asked
of
him the same thing.
course.
Because he actually pitched the same thing. He has access to lots of carriers. So I just asked him at the beginning of our call, how do you even go about like choosing one or showing me one?
Yeah.
And I don't remember how he responded, but how did you go about? I gave you my basic details. How did you go
Yeah.
about choosing this one?
Midland National is like a very well-rounded IUL, like a to get started to see what is out there, right? Midland National is going to offer the critical, chronic, and terminal illness rider along with the cash value growth. Midland National also has three different historical indexes that we can use. And then Midland National, based on your age and what you wanted
Hmm.
to contribute, I knew that the death benefit was going to end up being less than 100,000. Okay. And a lot of the other carriers have a minimum of $100,000 of death benefit, which would mean that if I showed you another carrier that has a minimum of 100, we're going to get to the guidelines and you're going to say, well, why is it not max funded? It's not the minimum death benefit. If you've done your research, right? Or
Hmm.
I'm going to have to sit there and be like, well, you're not technically max funding it, but I'm putting myself in a weird spot. So
Yeah.
Midland is going to give us that lower death benefit where it is literally max funded. We're going to get all of the extra healthcare benefits, and we have historical indexes, A plus rated company, been around since 1906, high financial rating on the Comdex. I believe it's 89 out of 100 last time I checked. They are an ESOP company, so they're an employee-owned company. They're not a
Hmm.
publicly traded company.
Oh, okay.
So I like that as well. And then two, when we go through like what else is being offered other than the living benefits, there's also something called the protected death benefit. So being that you're so young, we don't know what's going to happen in 40 years, right?
Correct.
But if you keep this policy and in 40 years you're like, I don't want this policy anymore. I don't need coverage. I don't want it. Whatever it is. Something I like to say is like if you're getting closer to retirement and you're wondering like what can you do with this policy and your retirement plan is like getting out of the country, right? You're going to go
Okay.
another place and you just want to take your cash and leave, right?
Yeah.
In most policies, if you try to surrender the entire policy, you're going to be hit with taxes, right? Because you get taxed on everything over your contribution. Well, Midland is going to say, hey, at age 65, if you'd like, we'll reserve that initial death benefit of 79,000, keep it over your head, pay it out to your beneficiary when you pass away, and we'll write you a check for 394,000, tax and penalty free,
Wow. Tax free or tax?
tax free.
Wow.
Yeah. So that's like a
So,
pretty like it's hard to plan that far, but
yeah.
this gives you the option of like, okay, I could escape from this. I can use it if I want to use it. Like you have options.
So I think I understand, and it sounds neat. So 394 grand would come to my bank account, but that 79,000 of actual death benefit would stay in place and no more premiums.
Yep. No more
Okay,
premiums, no more interest, nothing.
that's neat.
Yeah.
So it's not, it's like kind of selfish, but not that selfish
Yeah. You're
because you're
like,
still
hey,
leaving something for
you
sure.
guys got 80 grand, whatever. Like you're fine. And you got all my other assets, right?
Yeah.
Kids, future potential kids, you're gonna be fine. So I really like that. And I, of course, like as we're going through this is not my only option for you. Like I would say, hey, what do you like about this? You like the living benefits? You like the indexes? You like the protected death benefit? And if you said, the living benefit's okay, is there something with better cash value? Say potentially, yeah, but it's going to have that
Okay.
higher death benefit of 100,000, right?
Hmm.
So we just need to look at those numbers and those guidelines and determine if, hey, it's not that far from being max funded. And in the future, I'm going to want to take advantage of the extra funding room anyway. Great. Wonderful.
Yeah.
Right. Also, there is something on this policy that I did include for you called a guaranteed insurability rider. Not all of the IULs offer this, so it's another reason why we like Midland. And what it's saying is that um, through age 40, right, you're going to be able to increase your death benefit coverage without proving that you're insurable. And you're able to increase it by 25 grand at a time at ages 28, 31, 34, 37, and 40. So
Okay.
that's over $100,000 of death benefit. But it's not about the death benefit because if you've watched any of my content, right, I care about the cash value. So my goal
Hmm.
is, hey, you can increase the death benefit, and what does that do? That allows you to put more money every year
Okay.
as well. So it's a way for us to be flexible with the policy and not have to create that extra funding room right now.
Hmm.
And it's
Okay.
costing us an extra $33 a year out of the
Oh, a
already
year.
cost of insurance. And then at 40, it just falls off.
Okay.
So
So
instead
you
of
can't use it anymore. That
then you
makes
can't
sense.
use it anymore. Like, so if you have, instead of the ages, you could also say, hey, I just got married. I want to increase my death benefit. Hey, I just had my first child. I want to increase my death benefit. And then you would be able to contribute more money.
Hmm.
It's a way for you to not have to get another policy as well if your coverage needs change.
Okay. And I thought it was 33 monthly at first, but no, that's $3 a month roughly.
And
A
that's
little
already
less.
coming out of what you're already contributing, right?
Okay.
So that's a pretty cool thing. And then if I go back, remember how I mentioned that overloan protection, where if you take out too much money, it guarantees that your policy won't lapse due to a large
Hmm.
outstanding loan. So we have the same thing, starts at 65. So
Okay.
if you don't take the deal, right, and you start taking out money, well, now your policy is protected. If you were to ever loan too much, there's still going to be death benefit coverage, and you're not going to get hit with taxes or penalties.
Okay.
So either
So
way,
two
there's a
both
lot of
options.
fail safes. Yeah, exactly. Other questions about anything so far?
One thing he asked about
Mhm.
is just how like general healthy I am. I don't know if I gave you much of that. Like I like to think I'm pretty healthy, but I didn't know if you needed that.
You know what? I should have gone over the health rating. I just ran it at a standard. I'm going to draw through it,
Okay.
but I just ran it at standard. I do that no matter what, right? I saw on the illustration that, it was non-tobacco, so I assumed that you were
Yep.
not a smoker. And then I just ran it at standard. His was ran at preferred. But I
Okay.
always keep these underwriting guidelines up right here.
Oh
And
wow.
ultimately, but I still just run it at standard because I'd rather show you the standard. And then they come back and they're like, yeah, preferred plus. I'm like, okay, you know what that's going to do?
Okay.
It's going to lower the cost of insurance and
Okay.
lower our minimum contributions as well. All right. So that's like,
Okay.
for me, the way that I do my business is like we strategize, we talk numbers, we look at all the different options. And once we're getting closer to, okay, I think I want to go through with this, I see the value. Now let's talk about underwriting, right? Like
Gotcha.
we would do this for an hour. We'd probably do another hour, look at some
Hmm.
more illustrations. We might even do
Yeah.
a third hour until you're like, okay, I think I'm ready to go. Like, are you
Yeah.
sure?
Not
And
a 22-minute call
now
over the
we're gonna
phone.
do exactly. Now we're gonna do an application. So like no
Gotcha.
application, nothing until the very end.
I like
Not
that.
even to like not waste like my time, like not waste your time. Like why are we gonna do all of this? Like give me your social before you know it.
Yeah. I was very confused and uncomfortable.
Yeah, like bro, like I don't even like I wouldn't even ask you your height and weight unless you brought it up,
Yeah.
You're like, "Hey, I'm pretty sure I'm healthy. Like, what'd you run this at?" Be like, "Oh, just ran it at standard. I'm sure you're healthy too, man, but that's not even what we're talking about right now."
Yeah.
Oh, it's just very backwards to what most insurance agents do.
I
But
gotcha.
okay, index allocations. So, these are the ones with Midland that we have here. And we have the S&P 500, 10.5% cap.
Okay. Well,
Two
that's
points higher.
2% higher.
Yep. 100% participation rate and a 0.25% floor. So it
Okay.
goes negative, you get 0.25. We get everything up to the 10.5% cap. Then we
Okay.
have the Fidelity. I'm not using the Fidelity. Fidelity is just like the BNP Paribas. It's proprietary. It's got like 5 years of history. I'm not using it. It's got no cap. Those big 200% participation rates. Fine, cool. Just I the incentive is not enough for me to use it on my illustrations,
Hmm.
in my opinion. I'd rather use the historic and then tell you about this. Yes, there is these indexes that we could take advantage of if you want. There is a 1% bonus years 1 through 10 with this one. If you've
And describe bonus to me.
Yeah, it's just a bonus on whatever money is contributed here. So if you allocate 30% of the money to the Fidelity, then 30% is going to get a 1% bonus no matter what, along with the
Okay.
yeah. So I'm not using those, but I am using the S&P 500 again with spread. So the first one was with a cap. This one's with spread, so there's no cap, 100% participation, 0% floor, but a 6% spread rate. So spread rate, they're going to subtract 6% from whatever the index earned for the year, and that's what you would get credited.
Okay.
And I'll show you some of the historical differences, but there's 30% in each of these. So now there's a total of 60
Hmm.
in the S&P, 30 here, 30 here.
That's
Then
what the dark means.
those are the dark ones, yeah.
Okay.
And then you have the S&P mid cap 400. that has an 11.15% cap, 100% participation, 0% floor. And then I'm using the fixed account, like I told you I would have done over there. So it's earning actually a 4.5% fixed rate
Okay.
a year. Conservative for sure. I got 20% there and 20% here. Um, so a 30-30-20-20 split. You also have the Russell 2000 that has an 11.35% cap. You also have a S&P monthly. So instead of tracking from January to January, you track January and then February's growth and March's growth, and you can get as much as 3% each month, and then that's added up over the year. But that's a good one. It's more volatile. And then you have a high par S&P, which means we get a 9.65% cap, but 140% participation. So they give you a little extra. And then the uncapped S&P has no cap, obviously, but we get
Hmm.
only 62% of the growth.
Okay.
So what is one, two, three, four, five different variations of the
Yeah.
S&P, the
Wow.
S&P mid cap 400, the Russell 2000, the fixed account, and two versions of the Fidelity multi-factor index,
Yeah. I like that I recognize all those except that Fidelity.
right?
That's good.
And even Fidelity is a recognizable name, but
Yeah,
it's,
true.
not a historical index.
And two things.
Tell me.
Let's say we do this year one, we could change it year two, right?
Absolutely. Yeah.
And then from what I understand is like those can change. Do you see them change often, increase or decrease at Midland National?
I've seen them do both. I've seen it go down from 9.5 to 9.3 in the past on a earlier product, and then I've seen it go from 10 to 10 and a half.
Okay.
Now, little insider knowledge is that it's not as often that they just straight up change all the caps and lower them and increase them. It's more so that over the last like however many years, the strategic accumulator IUL 2 was the product, okay? For the last basically call it for my experience, the last 4 years, I've been
Mm,
using the IUL strategic accumulator 2 from Midland.
okay.
But then in August, so we're coming up on a year, they changed the product and now it's the strategic accumulator IUL 3.
Okay.
And what they did is all of those indexes before, um, they're not locked in, obviously, because things can change, but the actuaries at the company are saying, hey, this group of people can have this cap rate on the S&P. Now our new product, they can have this cap rate and we can afford to give them a higher one. So it's not that they went and changed everybody's. They just say we're going to
Hmm.
re-release the product and now this group gets these cap rates based on our performance, our, estimates of what we're going to return and then the, overall cost of the policy. The new strategic IUL 3 actually decreased in fees as well,
Okay.
which is interesting because decreased in fees and increased in caps because the company was doing really well, right?
Okay.
But that didn't affect anything from the old group of people, right?
Hmm.
But I did see their caps go from that 9.5 to 9.3.
Okay.
That was like the
That's good
biggest,
to know.
biggest change. So 8.5 is like, no, that's embarrassing. Agent guy who was working with you. No, I don't know what you're talking about. 8.5 is competitive. Those are our indexes. If we go down, I just want to show you the spread because that one's just like a little bit different. If we look at the last 2 years over here, this is the S&P with a cap. This is what the index returned, and this is what the IUL would have been credited, right?
Okay.
Um, so the last 2 years, the S&P returned 23.8 and then 23.5, right? Well, with the cap, we get 10.5. But
Okay.
with the spread, we would have gotten over
Oh,
17.
wow. A lot better.
A lot better. In 2021, it was credited 20. So a lot of my clients got between 17 and 22% over the last 2 years, each
I
year.
see the draw of that.
So I like to do 30% here because we're often going to get that cap. Okay. And then basically pick up the slack on what we're not getting by utilizing the spread. Now, of course, if we go back, let's say a year where the S&P returned 10 and a half, well, we got 10 and a half, but over here, we only got 4.5.
Hmm.
Right.
I
So
see
it's
things.
kind of
Okay.
everything up to 10 and then everything over 6 kind of make up for it. And then two, even the spread is returning higher long term with it
Oh
at
yeah.
8.8 versus an average of 7.4. And that's really just because we have potential of higher years. But we're going to see more zeros, right, with the
Mm.
spread, just because if it doesn't return much, 3.5 turns into
Goes
nothing,
away.
1.5 turns into nothing. But over here, that 3.5 turns into 3.5. So I'd rather us get whatever it's going to return and then make sure
Yeah.
that we're also not going to miss out on these, double digit.
Oh, that's right. We did it in both, didn't we?
Yep,
Read it.
30
Okay,
and
that makes
30.
sense.
30 and 30, and then the S&P mid cap is going to hit that 11.2 a lot as well, and it's averaged to 7.9.
Okay.
The uncapped S&P that only has the 62% participation rate is actually pretty competitive as well. It's averaging an 8.2, a little bit higher even. But it's a lot more volatile. If you see like 14, 14, 0, 16, 10, 17, 0, 17, or 12, 6, 0, 7, 18. It's just not as consistent. So
Mm.
I don't use it much. But at the same time, like it's the S&P. So however we wanted to kind of put majority of the money in the S&P and how we want to take advantage of it, we really can't go wrong. Because even
Yeah.
the monthly is even more volatile
Oh
than
wow.
this, but you're also getting huge returns, like
Mm.
21.8 turned into 21.4,
Okay.
right? But then it can be weird where 22% only turned into 12. It
Why
must
is
have
that?
dropped off in one of the
Oh.
couple years, right? Or 1 month. If 1 month it returns 12%, you only get 3.5 for that month.
Mm.
So it has to be consistently growing every month to really add up to a high return, which is absolutely
Gotcha.
possible. We got 26.5 turning into 23, right?
Hmm.
18 turning into 18, but you also have, 18 turning into zero.
Oh wow.
Like
That
what?
is
So
crazy. It
I
makes
don't,
sense spreading it around. It
yeah,
does.
makes sense. Just like track it in different ways. And then the Russell, a little bit low on the average return. It's pretty volatile as well. We got a good amount of zeros in here, but otherwise it is still pretty consistent with Midland. If we keep going, we got our projections. So our projections, we're actually seeing a 2% guarantee no matter what, but it's not a you get 2% as like a floor. It's like over time, if the policy didn't at least return 2% on average, they're going to true up the policy to equal a 2% return. Say
Okay.
year 20, right?
Not every year.
Not every
Not
year.
every year.
And then this middle column is showing a 4.5% return long term. And then this column is going to show 80% of the money is going to earn 6.3 and 20% is earning 4.5. So I put
Okay.
this in specifically to under illustrate on purpose because we just saw 7.2, 7.9, 8.8. I'd rather show you 6.3%.
Okay. Nice.
But $300 increasing
Yep.
death
Same.
benefit, right?
Okay. That's different.
3,600 goes in year one. We've got $2,700 earning interest, and we got $1,100 in the cash value.
That's good to see a number there.
Boom. Yeah. And the death benefit's also going to increase over time, right? So it's increasing by the total value of the policy. If you were to take 79,000 plus 35,750, you're going to get
Oh.
145.
Okay.
So the death benefit's increasing by the total value of the policy. Now, the surrender period was only 10 years long.
Mm.
So by year 11, you have 40,000 earning interest and you have 40,000 available. Midland allows you to access 92% of whatever's in the cash value as soon as there's a cash value.
Okay. 92% of cash value as loans, right?
Yeah. So let's see. I have this going all the way through. Of course, 72,000 in 20 years. We got 102. And we also now have 227,000 of death benefit, 108 grand if we never change the premium, went up to 230. We have 362 in the death benefit. And then I have um, money being contributed until 64, 65. 144,000 went into the policy. No more money goes in. So that 144 resulted in 467. We had over 500,000 in the death benefit. and I was able to pull out a consistent 42 grand every single year for the rest of my
Wow.
life. So now you're 75, you put in 144, you pulled out 420,000, you're still earning interest on 906, and if you were to pass away, your family's still going to get 422,000.
Wow. Off 144
Night
grand.
of 144 grand, like you're 950,000, like this policy would have gotten there eventually. And if you didn't take the money, you would have had the $1 million in coverage. So it's
Yeah.
like, you could
Wow.
have built up the death benefit to have that coverage if that's what your priority ended up being, or
Hmm.
42 grand a year. Because let's see, now we're at age 85. No more money, still gone into the policy. You've pulled out 840,000. You're earning interest on 1.8 million, right? And the death benefit's still 410. If you had not taken out this 840,000, your family would have gotten something like 1.8 mil,
Oh, wow.
right? Because it's one or the other,
Okay. Yeah.
right?
Can't have your cake and eat it too.
You can't have your cake and eat it too, but we kind of are at the same time. You look at 95 years old, 1.2 mil came out. The death benefit started going back up. So now it's at
Wow.
683 because we're earning so much interest. And this 42,000 is not draining the policy. You're basically have been living off of the interest. And
Okay.
this account value is earning you more interest than what you're actually taking.
Hmm. Okay. That's
Yeah.
neat.
And that will last. There's your 105.
Wow. I hope I live to 119. I don't think I will.
But I did take it out forever. More so, I'd rather you
Wow.
see that it could go forever than I love this response too. So tell me, what are your like night and day? What's up?
Yeah, literally night and day. One, just your general approach, which I enjoy. Uh, but then, yeah, this feels, and I assume you're going to show me like what his guide, the guidelines on the other policy are like
Yep.
10,000.
Mm-hmm.
And I'm assuming these are not 10,000. And Target, I guess you mentioned that as
I
well.
will show you that. It's all the way at the bottom. So there was a lot of key definitions up there. So here are guidelines. Uh, your guideline level
Mm,
annual premium is the max contribution per year,
that makes sense.
$3,600. Your minimum per year, that minimum no lapse is $801 a year. And the target premium, so your goal amount to keep the policy in force is $914.
Okay.
And this isn't even the full potential of the policy, right? Because you could use that guaranteed insurance
Oh, yeah.
rider and say, hey, increase it. And you're going to be able to increase your contribution to about $400 a month.
Okay. So you
If
said every like 3 years, roughly
every
25. You can increase it, have the option to increase it,
And you don't
25
have to,
grand.
but you can. So every 3 years, you could increase your premium to another $100 a month, another $100 a month. So the potential of this policy is actually so much more than what we're seeing.
Wow.
And I'm about to blow your mind one more time, because Midland actually offers a price break at 100,000 of death benefit. Which is where, like, next time we were to get together, like, I'll show you a couple other examples where the minimum death benefit is 100 with some other companies so you can see. But
Yeah.
so 100,000, and I'm just gonna get down to the numbers because everything else is the same. Um, so let's see. Here we go. 36,000 went in, and now we have 38. We had a little bit less money year one in the cash value. We actually already have more money in the account value. And let me go back up. Forgive the scrolling.
Okay. So you're
Uh,
getting a better deal at 100,000 death
Getting a
benefit.
better deal. So there was 1,100 at first, but there was 27, and then we had 35. Now we have 29, a little bit
Hmm.
less, and now we have 38.
Okay.
Right. And if we keep going, I'll just go all the way to the end because 100, I still pulled the same income, just keep it the same. But 144, now we have 495, and that's compared to having 467.
Okay.
Almost got us an
20,
extra 30
30
grand.
grand. Yeah.
Yeah. And if we go back, and let's say we go back to the guidelines and then we check these ones against it, we're going to see that now there is extra room. Kind of like I told you how if the minimum was 100, it's going to be a little bit
Yeah.
higher. So now you're not technically max funding. But if we think about 3,600, compared to 43. Okay, so there's 750 extra
Yeah.
dollars a year that could be contributed. Honestly, not that big of a deal. That would just
Yeah.
mean you could put more money, grow the cash value more. But look at this. Your minimum actually went down to
Oh,
7.
wow.
And let's check here. The target premium went up a little bit. We had 914 and 801. So now it's 1146, but then you have a smaller minimum, which makes
Okay.
sense because the policy is a little bit bigger.
Yep.
What was the jump? 20 grand of death benefit,
Yep.
right? It's a little bit of a jump, but it comes down to like you like the extra funding room. Like that's another reason I would do it. I do it because you can see in the cost of insurance that you're getting a price break. Even year
Yeah.
one is an extra $200 in your account instead of going to Midland just from
Yeah.
the 100,000.
And yeah, I don't think that extra room is necessarily a bad idea,
No,
honestly.
not at all.
If I get birthday money or a bonus at work or
Yeah.
whatever
Or
else.
you just want to increase I mean, that means you could increase your contribution to 350,
Mm. Yeah.
every one too, without having to use the guaranteed insurability route,
Mm.
So it just gives you some more flexibility. And
Yeah.
$750 a year actually goes a long way. We're talking about
And
compounding.
there's no need to look at the 7 pay premium right there or not.
There's not. Unless you wanted to put in extra money the first few years, you could contribute up to 53.73 years, say 1 through 5. But then
Mm.
as soon as you hit 23,000, which will
Oh,
only take you, then they're going to make you underfund the policy to stay within the tax limits. So it's really not anything
okay. I'd
big.
rather just keep it even. Wow, this is, and I guess last thing, let's say I get preferred
Then
healthy
all
class.
of these numbers are going to go down.
Okay, they're
Yeah.
gonna go down.
Yeah.
So I'll
So
be able to
you're
pay in
gonna
less.
we would still have it be at 3,600, but the minimum and the target are going to go down because the cost of
Okay.
insurance is going to go down. So you're going to have more flexibility. And we might see that the max contribution is closer actually to
Oh,
36.
okay.
Yeah.
Okay. Neat.
So I would just rerun it, right?
Yeah.
Once they gave us the approval, because I'd rather we go through underwriting and then they say, hey, you got a preferred plus. And I say, okay, perfect. Let me rerun the illustration and tell you, hey, it was this and now it's this. You're welcome. Because that's such an easier conversation to have than like, hey, I showed you preferred plus, but you actually only got preferred. So like you
Yeah.
want to do that. Much rather set myself up for a nice conversation where I look where I look like, yeah, look at I was fine with the 1146 or the,
Hmm.
914 target.
Yeah.
And now it's better. So I will send both of these to you also.
Oh, thank you.
Yeah, no problem. And then like I said, like this is not your only option, 100%. And then you know what? Last thing, because we talked about it with Ameritas. So your standard fixed loan is 2.75% years 1 through 5. It's guaranteed not to be higher than 6 years 1 through 5. But starting year 6, the loan rate is reduced to a guaranteed 1.5%, and the loaned amount earns a guaranteed 1.5%. So by year
Okay.
6, you're getting the net zero cost
That's
loan.
good.
The
Year
variable
6 plus.
loan, yeah, the variable loan, um, minimum of 3%, highest point is 6, so between 3 and 6%. All of the money earns interest with the selected index options. Great. But then we also have a fixed interest participating loan that says the max is 8. It's kind of high. The rate right now is 5.7. But what's happening with the fixed interest participating loan is that the loaned amount is not being moved out of the index options, right? And if
Mm.
your policy is earning 7% and we were paying 5.7, you're going to get a positive arbitrage on the loaned money of 1.3%, right?
Okay.
You're going to earn a positive interest rate. So that one, is very similar to the variable as well. But with Midland, they give you I just crossed it out, which is not helpful, but you're also getting an extra bonus on the loaned money. It's guaranteed to be zero point 0.5, but right now it's 2%
Okay.
interest bonus on the loan. So just a couple of perks of using it ultimately, but really good standard loan, variable loan, pretty typical 3 to 6%. And then we also just have this extra one.
Okay. That's
I think
perfect. Thanks for
that
explaining that.
is Of course. That is just about it. Not bad. It's like my favorite and my worst part about being in this business is like seeing horrible policies, especially when they've been purchased. That's
Yeah, true.
they've
Yeah,
been
that should be a very different conversation. I would
But when
definitely
it's
be
not
in a worse
purchased,
mood.
oh man. If it was not, oh yeah, no, I'm like,
Yeah.
okay, so it's a whole like I'm not excited either. Like, but this situation where you didn't purchase it, I'm like, let me
Yeah.
show you how good of a decision that you made by
Yeah.
not doing that.
And
Like,
I think you've mentioned it before that this is literally people's hard-earned money. I don't know how anyone could feel good about not doing the best for them. Like, I
I
don't know. That doesn't feel good to me.
no, seriously, like it's wild. It's wild. And I've
Well, I
seen,
appreciate this,
of
Casey.
course, no problem. I've seen worse. I've seen if you've watched my YouTube, you've probably seen me talk about the lady who was contributing
Yes.
1,500 a month,
Heartbreaking.
veteran, no money. Literally
Yeah.
nothing. Just like cool, 3 years in. It's wild. So yeah, so I love to see that you're happy about it. I'm like, yes.